A few weeks ago, these were the hottest stocks on the entire market. And today, 5 of them got torn apart in a single session. So it's either your worst nightmare or the setup of the year if you're an investor. One headline did all the damage as well, but I don't think that the market fully understands exactly what happened. And by the end of this video, you'll see why the answer isn't what everyone's actually screaming. And it's funny, in the last video, I talked about just that. The market is selling fear instead of facts. And this is perhaps no better example. So you have Nebius, IREN, Cypher, TeraWolf, and White Fiber. And the market has grouped them in the same basket and sold them all off simultaneously. So the question is, what do they all have in common? Well, it's AI, GPUs, cloud compute, being NeoClouds themselves, power, data centers, and high performance compute. So as of July 7th, 2026, the sell-off has been absolutely brutal. You had names like Nebius go from a high of $300 all the way to under $200 in just 5 trading days. Names like Cypher went from $31 to a low of $19. You had TeraWolf go from $29 to a low of $20. You had White Fiber go from $44 to a low of $32. And you've had IREN go from a high of $74 to settling around $39 as of right now. So naturally, investors are asking, is this sell-off actually real? And is the AI infrastructure trade over? So my honest take is no, the AI infrastructure trade is not over. The stocks themselves ran extremely hard, the trade got overcrowded, and all it took was one headline to spook fear into the markets and sell off the entire stack. And that one headline is what Meta said. But we're going to get into that a bit later. For right now, it's important to know that the fundamentals did not break. The biggest fear right now is excess compute. So reports came out that Meta is looking at starting their own cloud business to sell off excess compute. So naturally the market went, okay, if Meta is willing to sell off that excess compute, does that mean that they have too much? And does that mean that the AI trade might be in jeopardy? Because that's the exact bear case. If hyperscalers overbuild, that is the market's worst nightmare. Pricing will fall, utilization will fall, and NeoCloud's margins will naturally get squeezed, and the weaker players will get exposed. And don't get me wrong, this risk is very real. But I think naturally, the market did what it always does, and it took one headline out of context and put it way too simply. Compute is not one giant commodity. Location matters. Chip matters. Power and compute matter. Networking, training versus inference, customer access and contract structure, they all matter. And more importantly, it does not mean that the entire compute market is oversupplied. And here's the contradiction that runs through this entire video. While the market actually panics over excess compute, hyperscalers and AI infrastructure companies are signing massive deals right now. And that is precisely why I think that this is just a valuation reset on a bit of fear rather than the whole trade unwinding. So a quick question for everyone before we go a little deeper. I want to hear it in the comments. Do you think that this pullback is a gift or an actual warning sign from the market? I genuinely want to see where all of you land on this one. And now naturally, with this said, I want to work our way from the top down. And that starts with Nebius, the clear NeoCloud leader. It's not a Bitcoin miner rebranding an AI. It's actually a true cloud company. So as we can see right here, in Q1 2026, Nebius did nearly $399 million in revenue, which was up from $50.9 million a year ago. And that's a crazy step function change of nearly 684%. Also importantly, they had adjusted EBITDA of $129.5 million versus a loss last year. And they also secured up to 1.2 gigawatts of power and land for a new owned AI factory in Pennsylvania. So in Q1, they obviously made significant strides in expanding their AI platform and moving towards more of a complete full stack. And then there was a big contract that happened. And yes, that was with Meta. Nebius signed a 5-year Meta AI infrastructure deal worth nearly $12 billion for additional capacity, and that could push it to nearly $27 billion when it's all said and done. So I want you to sit with that for a second. The market is saying that Meta has too much compute, and that's exactly what the headlines read and why everything sold off. But in the past, Nebius signed a massive up to $27 billion contract for compute. Not to mention, Google also said to Meta, hey, you guys got to stop using all of our compute. So this headline just doesn't make any sense. And this is why exactly I think the market is reading way too far into it. And that one line is an entire contradiction. Now, with that said, that does not automatically make Nebius cheap. And at this valuation, management still has to execute nearly perfectly. But if you want the cleanest, public, pure play way to play NeoCloud infrastructure, I think Nebius would be the way to go. And with that said, I wanted to talk about all the other NeoCloud names because they do present a very interesting opportunity and they're all different in some regard. And to be honest, I'm bullish on all of them. So as we can see here, Iron is one of the cleanest Power Plus AI cloud stories in the group. Their customers are very, very strong. Their operational capacity is fully contracted. They have 3.1 billion in ARR under contract. They have 3.4 billion in a 5-year AI cloud contract with NVIDIA. And they also have a 5 gigawatt strategic partner with NVIDIA itself. Not to mention, their Q3 fiscal year 26 revenue was nearly 144.8 million, which is hitting an inflection point. Their adjusted EBITDA was 59.5 million, and the 2026 expansion to 480 megawatts remains on track. So with that said, that changes the entire conversation for IREN because they're no longer a Bitcoin mining company anymore. They have now become a vertically integrated AI infrastructure platform that has tons of land, power, and compute available. And not to mention, they have major and credible customer demand. So if compute becomes scarce, which it is, and it stays scarce, IREN will definitely benefit because it controls most of those scarce inputs. So now Cypher is bullish in a completely different way. When you look at the numbers, they're not going to immediately jump out at you. In Q1 2026, the revenue was only 36 million and their adjusted EBITDA was negative 48 million. But Cypher is not being valued on today's numbers like I just said. It is being valued on whether it can turn power-backed sites into HPC contracted campuses. And this is precisely where the contracts matter. Cypher has actually secured contracted HPC agreements across 15 years in 2 different leases. So one of them is a 15-year, 300 megawatt lease with AWS, and the other one is a 10-year, 300 megawatt lease with Google and FluidStack backing it. So that is exactly the bullish point. Cypher has AI and cloud demand showing up in the contracts themselves. And if the market starts respecting that again, the re-rating will continue for Cypher. Now I wanted to move on to the third one, and that's White Fiber. It's a relatively undervalued and underfollowed name. Yes, it is smaller, but that allows for higher risk, but much higher upside potential if the NeoCloud trade turns back on. The bullish part is that White Fiber is not just a tiny GPU wannabe cloud infrastructure provider. It actually already has contracted revenue visibility. White Fiber actually has nearly 921 million in remaining performance obligations, or RPO, for contracted revenue services. They also signed a 2-year hyperbolic agreement worth around $17 million in total. And for a company specifically this size, it matters a lot because it shows demand is there for its GPU and colocation services, is TeraWulf. TeraWulf has forced the market to re-rate the entire business. In Q1 26, the revenue was nearly 34 million, including 21 million of HPC lease revenue. Then just recently, on July 6th, and perhaps the most notable thing that's happened at TeraWulf, is they announced a 20-year, $19 billion contract agreement with Anthropic. And to put that in perspective, Anthropic is not just some random tenant. It is one of the most important and key AI names on the entire planet. And it is willing to lock up long-term backed infrastructure agreements with companies like TeraWulf. So that clearly speaks volumes about TeraWulf's credibility in this space. So when people say that NeoClouds are quote unquote dead, I think that's just extremely lazy analysis. And it's important to note that these companies are not all identical as I just walked through, but they all benefit from the same buying pressure. And again, AI demand is growing fast and they're all going to benefit in their own way. So here's how we're going to do this. First, Vojtech is going to come in and break down the chart and analysis of Nebius. Then I'll take over separately. I'll do the valuation and give you some numbers behind our thought process. Over to you, Voj.
Thank you, Mitchell. So from a technical perspective, Nebius could not look any better over here. As you can see, we have had a beautiful impulse wave 1 to the upside, followed by a controlled ABC correction to 0.5 FIP, where we aligned with the 50 weekly moving average. We have found support on the previous all-time high, and then we shot for wave 3, which has finished right at 1.618 FIP extension level, which is absolutely standard, and we love to see that. Right now, we are in wave 4, and we seem to be finding support in between 0.382 FIP and 0.5 FIP, which is also standard for a wave 4, and also at this 1 FIP from the Fibonacci extension tool. So everything about this movement is standard, and we believe that there is more gas over here with Nebius, and wave 5 could finish anywhere in between 2 FIP and 2.618, which is approximately at $405. If we look at the RSI, we can see that on the weekly time frame, it has corrected a bit. So there is more room and space for this wave 5. We overall like this chart. We are bullish on Nebius and we expect more upside from it. That is all from me, and back to the Mitchell.
Thanks, Vojtech. So now let's actually put a number on it. So here's the headline. We have Nebius as a buy with a price target of nearly $299 a share, and that's more than 30% above where it trades today. And this technically isn't a fresh call. So back in February, we flagged Nebius at $97 with a target just under $200. It obviously went all the way up to $300 and has since pulled back to under the $200 level. And so in our view, this is another opportunity that the market is giving us. So you might be asking yourself, okay, well, how do you get to $299 price target? Now, unfortunately, the DCF model isn't the best metric here because you would really have to forecast out a lot of that revenue, a lot of that recurring CapEx that is coming, and it wouldn't be the most reliable method as it stands right now. So it's easier to do it through two other methods, which are the EV to sales, which is around 17 times, and it gets you to roughly $295. Or you can do an EV to EBITDA, or you can do the EV to EBITDA multiple, which I like a bit more here. And as it says, so Nebius's multi-year contracts begin to ramp into recognized revenue, and the appropriate valuation lens shifts from that trailing to forward metrics. So when you look at their next 12 revenue, it's expected to reach approximately 5.3 billion. EBITDA is forecasted to increase by approximately 2,000%, which is just insane. From nearly 118 million on a trailing basis to nearly 2.45 billion over the next 12 months. Approximately implies nearly 46% on forecasted revenue. Now, in our eyes, this is a level that is entirely achievable as the higher value hyperscaler contracts ramp and the fixed infrastructure costs are going to become increasingly spread across a much larger revenue basis. Now, it's also important to note that this is a business that will have significant operating leverage once that build out phase matures. So for our EBITDA multiple, we benchmarked it against current competitors, which CoreWeave is one of them, and they trade at approximately 30 times with a 12-month average of 35. And so we believe that a 35 times forward multiple is more than appropriate for Nebius, considering how stellar their execution has been, and that gets us to a base around $302 a share. Now, the number that isn't shown there was deferred revenue, and that's one of the most important numbers I wanted to talk about because it exploded from nearly 1.6 billion to 4.8 billion. And that's cash that customers have already paid for compute, but they haven't actually used yet. And that's contracted demand that's already locked in, waiting to be realized into revenue. And now on top of that, you add $9.3 billion of cash on their balance sheet and guidance of 3.3 to 3.4 billion in revenue, and the picture starts to become a lot more clear that this quarter will be an inflection point for Nebius. And here's the truth. A stock being down 30% doesn't necessarily make it cheap. Just the same way a stock being up 200% doesn't necessarily make it expensive. And as always, the only things that actually matter are execution, future cash flow, dilution to shareholders, and the multiple that the business actually deserves. And if you want to go even deeper, day-by-day chart analysis and the full bear base bull models are in our Patreon group. But the core thesis is still all right here in this video. So to circle back, is the NeoCloud trade actually over? And the answer is no. I think that the AI infrastructure trade is still alive. But with that said, the easy money has definitely been made already. The market is no longer going to reward every company that just says AI, GPU, or cloud infrastructure provider in their name. So from here, it's simple. The real winners are going to be the ones that can actually prove real demand. And that is precisely why Nebius matters. That's why IREN's deal with NVIDIA matters. That's why Cypher's deal with Anthropic, Google, and FluidStack matter. That's why TeraWulf's Anthropic deal matters. That's why White Fiber's RPO and backlog matters. And so overall, my view plainly is this. The AI demand is still there. Compute is still scarce, and these companies are more important than ever. But I think this pullback is healthy. Expectations definitely got too far ahead of themselves, and the charts went a little parabolic. And so it was time for a healthy reset. And so, with that said, the opportunity is not buying every name blindly. It's understanding which ones are going to provide the most value. So tell me in the comments which one you'd bet on, and I'll see you in the next one.